Hello everyone. In this chapter I'm going to discuss chapter 7 from the financial accounting course. The title of the chapter is financial assets. I'm going to discuss what are these financial assets and how to take them into account when we are doing our journal entries and closing entries. To start with, we have a set of types. So types of financial assets. We will start with cash and its equivalents. We have something called short-term investment or investments, and finally receivables. And when I say receivables, I'm referring to the two types that we know about receivables: account receivables and notes receivable. Okay, cash and its equivalents. Cash, you know what is cash. Equivalents of cash is a check, for example. In some other countries, there are several other equivalents of cash. We don't care that much about the equivalents because, you know, when you receive an equivalent of a cash, you will know that it's an equivalent of cash. So just think about cash and its equivalents as checks, for example. The other type of financial assets is short-term investments. We refer to these as, it might be a stock in another company, a bond in another company. So if you go and invest in another company, you buy their stocks, it means that you are investing in this company. If you lend another company some money, it's called a bond. This is chapter 10. So don't worry about this. This is simply when you lend another company, when you are the creditor. And there are other types of short-term investments. For an investment to be considered as a short-term investment, it should be highly liquid. Actually, the three types of financial assets are highly liquid. Cash is already cash. And let me remind you that liquidity is the propensity or probability or likelihood of converting an asset into cash within a short time. So cash is already cash, so it is liquid enough. Short-term investments, stocks, when you buy a stock, you can sell it right away or maybe in a couple of hours. So it is highly liquid. Receivables, this type of assets are expected to be converted into cash within a short period of time, within 1 week, 1 month, 2 months, or whatever. Now, in our balance sheet, we have a basis for valuation of these financial assets in the balance sheet. Okay? So, for example, when you have some cash, you will list the cash or record the cash in your balance sheet at its face amount. So if you have a $100 face amount, if you have $100, you will place it as $100 in the balance sheet. If you have, let's say, some stocks from another company, and you bought each stock for $10, and today these stocks are worth $9. So you will record them in the balance sheet at their fair market value. Fair market value. So the market value is the value of the investment or the stock in the market today upon recording it in the balance sheet. So fair market value, or the market value for simplicity, is the basis of valuation or for valuation in the balance sheet for short-term investments. Short-term investments are also, we refer to them as financial securities. Financial securities. Okay? So short-term investments or financial securities are similar, such as stocks, bonds, and others, financial derivatives, and so on. These are advanced topics. Receivables, account receivables or note receivables, we record them or we value them in the balance sheet based on the net realizable value. And we will discuss in this chapter or in this video how to compute this net realizable value. So I will start with short-term investments or financial securities and proceed to the receivables part, which is the bigger part. Cash and its equivalents, we will not discuss in this video any details about it. You need only to know that cash and its equivalents are stated at their face amount in the balance sheet. Previously, we used to discuss how to reconcile our records with the bank or simply prepare a bank reconciliation report. But in this term, we decided to exclude this part. So short-term investments. Basically, let's start with an example. So short-term investments. Number one, or part one. Assume that ABC company purchases 4,000 shares from XYZ company. So it's just like saying that Samsung purchases 4,000 shares from Apple. So they hold 4,000 Apple stocks. Okay, shares or stocks are the same. ABC paid $10 per share. So usually what happens, a representative from ABC goes to the stock market and he or she asks the broker for 4,000 shares for this company. They pay them in cash and get the shares. Okay, they paid $10 per one share. So the accounting record in this case is Marketable Securities, which is the asset in this case. So these shares, given that they are not our shares, so they will not show in the owner's equity section, they are other companies' shares. So you are investing in another company. They are called marketable securities or financial securities. The value of them is $10 multiplied by 4,000 shares, which is equal to $40,000. Okay, you paid for this in cash, so credit cash $40,000. Good. So this thing is an asset. Okay, highly liquid. So it's a financial asset, highly liquid asset or a financial asset. Number two, or the other case. Assume that ABC receives $0.3 per share on the XYZ stocks that they hold. Okay, so you know, when you invest in a company, you hold the stocks of this company, and this stock receives annual or quarterly or semi-annual dividends. So in this case, ABC receives $0.3 per share of the XYZ stocks. So your cash increased by how much? By 4,000 shares multiplied by $0.3, and this is a $1,200. Why did you get, or why did you receive this amount of cash? Because you received dividends. So it's a dividend revenue. And this is very different from when we say dividends. When you say dividends on its own, you are paying dividends to your own shareholders or stockholders. In this case, you are one of the stockholders that are receiving dividends. Okay, so 1,200, 1,200. Now, number three, assume that ABC sells 1,000 shares out of the 4,000 XYZ stocks for $11 each. So you will receive a cash of $11 multiplied by 1,000 shares. So this is $11,000. And this cash, you received it because you sold some of your assets or your financial assets. So on the credit side, you will have a reduction in assets, which is the marketable securities. So marketable securities, the value of these marketable securities is 1,000 multiplied by 10, which was the initial acquisition price. So 1,000 multiplied by, this is shares, $10. So this is $10,000. The difference of the $1,000 is the gain. So this gain is called gain on sale of investment. This is $1,000. You can tell that the gain should be on the credit because when you credit your owner's equity, you are increasing it, and the gain, of course, increases owner's equity. Or you can simply see where you should place this $1,000 so that you preserve the equality. Okay. So the fourth case under marketable securities or financial securities, assume that ABC company sells 1,500 shares for or at $8 each. So now you will receive a cash of 1,500 shares multiplied by $8, which is equal to $12,000. The value of your marketable securities, which is your financial asset, it went down by 1,500 shares multiplied by $10, which is the acquisition cost, so $15,000. The difference between the 15 and the 12 is a $3,000 of a loss. So instead of having a gain, you will have a loss on sale of, this is on sale of investment, $3,000. Now the last case or example is when you reach the end of the cycle. So you still have on December 31, you still have 1,500 shares for the XYZ company, right? 1,500 because we initially had 4,000, then we sold a 1,000, and then we sold 1,500. So you are left with a 1,500, right? The stock, the XYZ stock, is currently trading at $9. So each stock, it has a price of $9. In order for you to adjust your records so that you realize this loss or incur this loss, you need to first compute the loss. So the loss is equal to $10 minus $9, which is the difference of $1, multiplied by the $1,500 shares. So we are talking about a loss of $1,500. This loss can be recorded as an unrealized holding because you are holding these stocks, holding loss on investment, and on the credit you are crediting your marketable securities. So the value of your remaining marketable securities is not 1,500 multiplied by 10, which is $15,000. Instead, it's 9 multiplied by 1,500, which is 13,500. So you need to incur a loss and reduce the value of your marketable securities. This item over here is an asset, and I mentioned this before, and this item over here appears in the owner's equity section. Owner's equity section in the balance sheet. Okay? This is everything you need to know about marketable securities. The other type of the third type of financial assets is account receivables and notes receivables. Usually, of course, you know that account receivables are highly liquid, and usually they convert into cash within 30 to 60 days. This is the average in the States. As the period of collection extends or prolonged, the probability of collecting this account receivable becomes lower. So if you are selling on credit and you sell today, assume today is Jan 1, after 90 days, the probability of collecting this receivable that you sold back then, 90 days back, let's say is 98% of collection. The percentage of collection or probability of collection. After 180 days, the probability becomes maybe 60%. After 270 days, it becomes 20%. After a year, you know that you will not collect this receivable. You know, in the real world, some companies go out of business. So a company closes, it goes out of business. So some of their suppliers will never receive their receivables. Okay? Those uncollected receivables for the supplier who issued the receivable initially are considered or categorized as expenses. So what happens is that there are 3 stages. Day 0, and this is stage 1. Day 90, and this is stage 2. And day 180, and this is stage 3. Of course, these numbers are examples. They might be different, 0, 90, and 180. What happens on day 0, you as the supplier, make a credit sale. Let me say a bunch of credit sales. So you sell to different customers on credit. So it's a receivable for you. After 90 days, those receivables, they are not collected yet. So an expense, due to the matching principle, whenever you have a generation of, whenever you are generating a revenue or realizing a revenue, there it should be matched to an expense. So an expense is associated with uncollected account receivables. Okay, so after 90 days, I said that the account receivable hasn't been collected yet, and therefore an expense is associated with this uncollected account receivable. After 180 days, assume that the account receivable proves to be uncollected. uncollected. Okay, so here you are 100% sure that this receivable will not be collected anymore. In this stage 2, you have a certain percentage or probability that the customer will default on paying. Default on paying means that the receivable will never be collected. Okay? Here you have to incur an expense, and here you need to remove the account receivable from your records. So here, incur an expense, and in the third stage, write off, we call it write off. Remove is write off in accounting. Write off the account receivable from your books or your records, to use a simpler language. So stage 1, in stage 1 you made a sale on credit, so you realize the sales revenue and increase your receivables, whatever the value is. This is easy. Stage 2, in stage 2 you need to estimate the amount that will probably be uncollected and incur the expense accordingly. So out of this bunch of sales, assume that you made a sale for 10 people and the total of these sales was $1,500,000. You need to estimate the amount as a percentage that will probably be uncollected and incur the expense. This expense is called uncollectible. So in stage 2, you are not 100% certain or sure that the account receivable is uncollected, but you are skeptical. You suspect that some part or percentage of these sales will be uncollected. So you need to incur the expense right away because of the matching principle. You generated this revenue and there's an expense associated with this revenue. You know, when you allow customers to buy on credit, you will buy much more than only restricting your sales for cash. So this additional service, it has an expense, it has a cost, which is the defaulting cost. So you need to incur this expense. So the uncollectible accounts expense should have a value, and this is estimated. And I will explain later on how you estimate. On the other hand, you should have something called allowance for doubtful accounts, or in other words, AFDA. Memorize this AFDA because you will see it everywhere and I'll use it from now on. This AFDA is like a reserve. It's like a reserve for possible defaults. So we're still in stage 2. We are suspecting that some of these credit sales will be uncollected in stage 3. So we need to create this reserve that accounts for these likely uncollectible accounts. So the expense is called an uncollectible accounts expense, and this is the AFDA account, which is a contra asset account. It decreases account receivables. Stage 3. In stage 3, what happens? First, before I move to stage 3, remember that at the beginning of the video, I told you that the basis for valuation in the balance sheet for receivables is the net realizable value. Now I'll tell you how to compute this net realizable value. It's the account receivable value minus the AFDA account. Okay, and remember that AFDA is the percentage of account receivables that will be uncollected according to your estimation. Okay, so net realizable value is equal to account receivables minus AFDA, and AFDA, this is AD, is the percentage of account receivables that you estimate to be uncollected. Okay, stage 3. Stage 3, when some of your customers, which are the account receivable holders, you are the holder, you are the customers, some of your customers proves to default, or let me say, some of your customers defaults on paying account receivables. What happens in this case is that you need to reduce your account receivable by crediting it, and on the debit side you will have the AFDA account, which is the reserve that you created for such cases. So as if you are anticipating that some of my customers will not pay their receivables, and this is the case in the real world, so you need to create this AFDA reserve, which is the step 2. In the third step, use this reserve when something actually happens. So some of your customers actually defaults, let me add actually here, actually defaults on paying their account receivables. Okay. Now, the question remains how to estimate the balance of AFDA. Remember that I said it's an estimation, so it takes place before the real occurrence. So is it a percentage from sales? For example, do you say that I estimate that 2% of my total sales will be uncollectible, or how? Let's see. We have two approaches. The first approach is the balance sheet approach, and it's simply based on the assumption that as time before collection of the account receivable increases, the likelihood of defaulting on the payment increases as well. Okay, and this is basically called the aging of account receivables. So as the age of the account receivable increases, the probability of defaulting increases as well. This aging thing it has an aging schedule, and this schedule is very, if you want, I'd say it's very logical. So you categorize your account receivables into age groups. So age groups of your account receivables, those receivables that are not yet due, those receivables that 1 to 30 days past due, receivables 31 to 60 days past due, 61 to 90 days past due, over 90 days past due. Okay, the value for the first one, the not due, let's assume it's $50,000, followed by from 1 to 30 days $30,000, 31 to 60 days $10,000, 61 to 90 days $5,000, and finally over 90 days past due $3,000. Then you have a probability of defaulting. Remember, probability is simply a percentage that ranges between 0 and 100%. Probability of defaulting, for the not due date, it's only 1%, as small as 1%. For 1 to 30 days, it increases up to 33%. So, and then 31 to 60 days, it goes up to 10%, then 61 to 90, 20%, and finally over 90 days past due, the probability of defaulting is 50%, which is very high. Then you will have the estimated uncollectible accounts. I want to mention something here, something good for you as students, is that so far everything is given. You will be given the values for each age group and the probabilities of defaulting. All you need to do is to multiply the value of the account receivables in each age group by the probability of defaulting for that age group. So 1% multiplied by $50,000 is $500. Then 30 multiplied by 3%, this is a $900. Then 10% of the 10,000 is a $1,000. 20% of the 5,000 is also a $1,000, and finally 50% of the 300 is $1,500. The sum of these is $4,900. So in total, you would expect that out of your total account receivables, $4,900 will be uncollectible or uncollected. This value here should appear in the AFDA. So AFDA should have this value. Now, assume that at the end of the year, your AFDA balance, remember that AFDA has a natural balance of credit. Your AFDA balance shows $2,400 credit, which is the natural balance of it. You need to adjust the balance so that it increases up to 4,900, which is what you should have according to the aging schedule. So adjust the balance. All you need to do is to increase your expense, which is the uncollectible account expense. So my expense is increased and my AFDA is now refilled. You know, when you go to the restaurant and you refill, you have a refill, the same thing. Your AFDA account is refilled or topped up by how much? 4,900 minus the existing, which is 2,500. So 4,900 minus 2,400, and this is a $2,500, and the same value appears in the expense. The other approach is the income statement approach, and this is a very simple approach. So the income statement, this is number 2, income statement approach, and this is a simple percentage. It's a simple percentage of total credit sales. Okay, so for example, if credit sales is equal to $1 million and you estimate 3% to be uncollected, then your AFDA balance should have 0.03 multiplied by 1 million, which is $30,000. So this is the balance in AFDA that should be maintained over time. As you know that account receivables, they might have an interest term and therefore they become a note receivable. So my last topic for this chapter is the note receivables. So as you know, notes receivable have an interest term. You will be given I, which is the annual interest percentage. Assume that I is 10% annually. It's always the case in accounting and finance. When you see an interest, it means the annual interest rate. Okay? The given is always on annual basis when it comes to interest. Note receivable principal value is equal to $10,000. This is also given. And finally, the period for the customer to pay back the money plus the interest is equal to 3 months. So now you can compute the interest expense. And the interest expense is equal to the principal value multiplied by I multiplied by time. The principal is $10,000 multiplied by 0.1, which is the annual interest rate, multiplied by time, which is 3/12, right? Because this interest applies to the year, and this is the portion or fraction of the year. So this will give us $250. Okay, so this is the interest expense that should be paid with the note receivable. Okay, now example. So in this simple example, I was just explaining how to compute the interest expense. Now a more comprehensive example. Assume that on December 31, you sold a security system for $60,000. The customer signed a note receivable by the amount three months note receivable at an interest rate that is equal to 6%. Remember that the interest rate is always annual. The question asks, record the journal entries or the required journal entries on December 1, December 31, and March 1. I made a mistake here. This is assumed that on December 1, not 31. So on December 1, you sold the security system. You expect the customer to pay you back on March 1, right? After 3 months. So you need to record the journal entries on December 1, December 31, and March 1. On December 1, you made the sale, so note receivable and sales revenue. On December 31, you have an adjusting entry for the interest receivable, because here we are the suppliers. So you will receive interest, and it's not an expense. On March 1, you will collect the cash of the principal value of the note receivable and the interest payment. Let's see how to do this. So December 1, make the sale. And this is very straightforward. So you have a note receivable, the value of it is $60,000, and this is a sales revenue for the same amount, right? Okay. On December 31, you need to record the adjusting entry that realizes 1 month of interest receivable. So if you think about it, this is the timeline. This is December 1. This is March 1. This is where you made the sale. This is where you will receive the cash for the note receivable and the interest. You have two stops before March 1. December 31 and then Feb 1, let's say. Okay, so December 31 is like saying Jan 1, it's the same. But because we close our entries on the end at the end of the year, we need to do the adjusting entry. So after 1 month, you deserve 1/12. Forget about this. You will receive a total of interest payment that you will receive. Is equal to the principal is $60,000 multiplied by the I is 6%, so 0.06. The T is 3 months, so 3/12, which means that a total of $900. This is $900. Okay, so this $900 you are receiving them because you lent the customer for 3 months. So in each month you deserve to realize 1/3 of the $900. So 300 over here, 300 over here, and 300 over here. Given that you only pass through the end of the cycle once, in this case, which is December 31, you need to record an adjusting entry for this period and say that, okay, I finished my year, I'm closing my entries. My investors need to know that I'm expecting to receive an interest receivable of $300 in March. How can I tell them this? I will simply have an interest receivable and an interest revenue. Remember that we record revenues whether you receive payment in cash or later on. But here at the end of the year, we deserve to record a $300, which is 1/3 of the $900, $300 as an interest revenue that will be received on March 1. Finally, on March 1, first thing you will receive is the cash of the $60,000 that will offset the note receivable. So now you remove the note receivable from your books and you receive the cash. The other part of the receipt is the $900 cash, which we computed over here. This $900 cash is an interest revenue. 300 of it has been already recorded on December 1. So the remaining of the interest revenue is the 600, which are these 2 months, right? The 300, this is an interest revenue. The 300 that is the difference between this 900 and this 600 is this interest receivable that you need to offset. So interest receivable, $300. Okay. So now if you sum these together and you disregard the time effect, this interest receivable will offset this interest receivable, and this interest revenue can be added to this one, so it will become a 900, and you have already 900 in cash. But given the difference in timing, you need to close your entries and do this adjusting entry. This is everything that has to do with notes receivable. My last thing, which is a simple concept in the ratio analysis about account receivables. You can compute a useful ratio called an account receivable turnover ratio. In this account receivable turnover ratio, it's simply dividing net sales by average balance of account receivables per year and it tells me how many times the company or the management was able to collect its receivables and lend it back. The higher the ratio, the better the efficiency of managing my receivables. Another ratio is called the average days to collect account receivables, and this is basically the number of days per year. Of course, this is per year, and this is per year as well. 365 days divided by this account receivable turnover ratio. So assuming that this number is 6, it means that the management, if this number is 60, it means that the management, 60 days, the management was able to collect its receivables every 60 days and lend them again. Okay, this is the end of the chapter. Thank you very much.